And how's everybody doing today? I'm gonna give you a minute to get on up in here. I'm gonna give you guys a minute to get on up in here. Tonight might be a little spicy. Tonight might be a little spicy. I'm sure we're gonna get some company that's gonna jump on here tonight, and they're gonna have a lot to say, right? So, before we get started, hope you guys had a wonderful and blessed day today. I'm not sure where you guys are at, but over here in Maryland, it is kind of chilly out here. So I hope you guys stay warm today. But I'm gonna give y'all a few minutes to get on up in here, and we're gonna talk about it. Um, and the conversation we're gonna have today is based on a lot of activity that I've been seeing on social media coming from these group of people. And what I'm gonna do today is educate you, right? Inform you, allow you to use your own thought process and not be moved by someone else's agenda or what they believe is the best for you. Okay? Because I think this is where a lot of people, well, even this is where the industry gets a bad rap or a bad name, because people are put into products that doesn't work for them, right? Something that they wish they hadn't gotten into. And we're going to go over it today. So tonight, the topic of this live tonight is the top. Hey Jonah, how you doing? Welcome to the live. The top 10 reasons. How you doing? Buy term and invest the difference often doesn't work in real life. That's what we're here to talk about today. The top 10 reasons why buy term and invest the difference doesn't really work in real life. And before I get started, I want to say as I go through this, and if you guys have a policy from this company or from these agents who tell you to buy term and invest the difference, feel free to DM me, feel free, and let me leave my number. Feel free to text me and we'll sit down and do a review. Also sit down so that way you can get a second opinion. My direct number where I can be reached is 443-208-5480. That's 443-208-5480. All right. So let's get into it. Buy term and invest the difference doesn't really work in real life. Number one reason is people don't actually invest the difference. That's the number one reason this thing doesn't work. Buy term and invest the difference assumes perfect discipline every month. You invest the premium savings, supposedly, and I put supposedly in a quotation because in most cases, you are not really saving money because their policy is usually expensive. Hey, listen, as we are watching this, as we are on this live right now, I want you to get your friends and family on here that have term policies from this particular company, or just term policy, period, because you're going to learn today the different options in reference to life insurance and what they do. Okay? I'm only here today to educate you. And then if you want to talk more in depth, feel free to DM me. But we're going to learn something today. Okay? Again, buy term and invest the difference. Assume perfect discipline every month. You invest the premium savings. You don't miss a beat for 20 or 30 years. Right? But let's talk about real life. Daycare, car repairs, layoffs, vacations, inflation, medical bills, and the difference becomes, well, catch up later. Most families don't automate it, don't increase it, and don't stick with it. I've been in business now for almost 18 years. And every time I run across these policies, I've only ran across 2 people in my 18 years that have actually invested the difference. And most of them are doing no more than 50. The 2 are doing no more than $50. The one lady who was just this year, I ran across her, and she's had her policy for 20 years and only had $2,300 in that IRA that they opened for her. And the reason why I met this lady was because a friend of hers is a client of mine, and she was talking about how she received a letter from that company about contacting her agent because her policy is now about to renew. And she was upset because the plan of buy term and invest the difference, she wouldn't need insurance later on in life because she should be wealthy 20 years later, didn't work out so well. So this is what I truly believe that this concept is hurting middle America, but more so the minority community. And the reason why I say that is this. In most cases, most minorities are not going to have money to transfer over. Most minorities don't have money like that. Most of them don't have businesses to transfer over, or at least a major business to transfer over. Most don't have any inheritance to transfer over. So life insurance is the one thing that they can possibly have that they can transfer wealth over to their family. But when you get with these companies that tell you buy term and invest the difference, and you should be wealthy 20 years later, well, the data says that's not true. The average retirement savings right now in America is $187,000. Right? $187,000. Everybody on this live right now knows nobody can retire off of that. Everybody on this live right now knows nobody can retire off of that. So that system does not work. It never has worked, and I don't believe it ever will work. because we know that wealthy people don't buy term. Again, if you're watching this, please grab your friends, grab your family, share the live with them, have them jump on. As we're going into 2026, it's education season. It's financial education season. I'm going to give you a couple of examples as to how this scenario don't work. Example number one, a 32-year-old dad buys a 20-year term policy. Okay? Says he'll invest $300, the difference, right? And he does it for about 9 months. Then baby number two, and then the rent increase and car note, and guess what? Contribution stops. But he still has term though. But he will never build the investment pile that was supposed to replace the insurance. So what does this mean? If you don't invest the difference, all you did was buy cheap insurance that will ultimately expire, or cheap insurance in my mind, which is you just giving the insurance company free money because they know you will outlive this policy. They know the likelihood is that you will outlive the policy. So they would take that money all day long. The average woman is going to live to 85, 89, somewhere around there. The average man is going to live to like 79, 81, somewhere around there. So if you buy a term policy, there is a heavy likelihood that is going to expire on you. So now you don't have insurance, and you also haven't accumulated the wealth that they say you're going to accumulate. What do you do now? Right? The term sounds good. It's cheap, it's inexpensive, right? But the problem with that is, as time goes on, right? As time goes on, and you're looking, and that investment that they say you should have, you don't have. The number two reason why buy term and invest the difference doesn't work is term policy often expires right when risk is the highest. Let me explain that to you one more time. I'll repeat that one more time. Term policies often expires right when your risk is at the highest. The biggest need doesn't always end when the term ends. Many people hit 50 to 65 with children, kids still needing help, whether they're in college or they're boomerang kids, which means they come back home. Okay? And they probably still need your support. If you are on this live right now and you're 50 plus and you have kids in college, right? Or you have kids who came back home and they need your help and support, I want you to type in the comment, kids. Because again, the thing with the buy term and invest, the difference is they're painting a perfect picture, a perfect life with no interruptions whatsoever, and with you investing consistently without any breaking points. If you have kids in college or you have kids who have moved back home, type kids in the comment. I want to hear from you. Okay? Also, the biggest need, again, is mortgage not fully been paid. That's another issue. We know 70+% of the people will die with a mortgage payment still on the bank. 70% of the people will die with a mortgage payment still on the bank. So if you buy term and supposedly invest the difference and your term run out, what happens if you pass away and your spouse or your family still owe the bank money? Right? Also, you may have a new spouse or a second family. Listen, we're getting real tonight. This does happen. You may also have parents who you care for. You also don't have enough retirement savings, which I just talked about. So let me paint you guys a picture real quick. Let me paint you a picture. They tell you to buy term. So let's say you're 30 years old, for example, and you buy a 30-year term. And they tell you to invest the difference. Okay, no problem. Let's say you're one of those individuals who actually invest the difference. And now you're 60 and the term goes away. Right? But you only have $300K for retirement in their IRAs or mutual funds or whatever they put you in. That money is eventually going to run out. But let's just say that money outlive you. And let's say you pass away and let's say there was 50 grand left from the 300,000 because you were using it. Your wife handled funeral for $25,000. That now leave your spouse $25,000. Is that generational wealth? And you're also still leaving her with a mortgage payment. I'm going to share a story with you guys that happened about 5 years ago, I believe. Right before COVID. I had a young lady call me from a client of mine that knew her, that gave her my number. She said, hey, my father passed away. He had only policy we saw that he had last was a term policy. So the man had a bunch of policies. I went to the house. I'm going through each policies, right? Now, I don't know what happened. I wasn't there. But I did see 2 policies that were whole life. And when we called them, they said he canceled those. Then the term policy, which was the newest one that he had, they said that ran out. So I'm going to assume that somebody told him to cancel the whole life policy and get term because it was cheaper. So the man ended up outliving the term policy. So he passed away, right? And they lived out here in Burtonsville, Maryland. with no money that was left to the wife. There was still a balance on the house of $120 something thousand, if I can remember. Payment was roughly almost $3,000 a month. It was a very, very nice house. So they had no other choice but to sell that property. And the mother moved in with the daughter because the mother couldn't afford to pay for that place herself. And the daughter had her own property with her husband. So this is what I mean when I talk about these scenarios, because if the father at least had a whole life policy or a IUL, then we know this will outlive the father. And mom will get a big chunk of insurance money that she can now use to pay off the mortgage. And she can live there with no mortgage payment. And she wouldn't have to move in with her daughter. So these policies usually end at the exact moment life gets financially fragile. These policies usually end when life starts to get dicey. Reason number 3 why buying term and investing the difference doesn't work. Renewal cost can explode after the level term ends. Let me explain what that is so you guys can understand what I'm saying. Whenever you buy a term policy, let's say you buy for 10 years, 20 years, 30 years, doesn't matter. After that time frame you bought it for, you can still keep the policy if you want to. But just know the premium goes up excessively every year after. So I'll give you an example. You buy a 20-year policy. Let's say $500,000. You bought it when you was 40. Let's say your premium was $100, for example. Now you are 60. Now, if you want to keep that same policy, your premium now might go to $280. Then the following year, $380. Then the following year after that, $480. So every year it becomes renewable. The only way to avoid that is you cancel the policy and you start over. A lot of people think that they think they can just renew, but renewal premiums can jump dramatically because of the fact that you are older. Let me give you a story. And this was about, I believe, last year. This woman purchased a 20-year term policy. At the end, she wanted to keep the coverage because she's still working and she has a lot of debt. She still has school loan. She has a mortgage. She has 3 kids, but one of them is the youngest one still living with her. Credit card debt. So she wanted to make sure if something happens to her, that her kids are not going to be the one trying to figure things out. And when she called the insurance company, The renew quote was so high that she had to drop it. Then she was diagnosed 2 years later. And now she's uninsurable. And when I got the phone call, it was to see if I can find her an insurance company that would take her. And I must have went through 6 different companies, and they're all like as soon as I put the application in, and I get to my car, decline. I'm like, damn. It's like it was so quick and so fast. These are the risks that people take when they buy these term policies because they think it's cheap. But what you got to understand is you're healthy now. You don't know where you're going to be later. I just did a policy for a guy in November, this past November, right? And he owned 2 properties. I did his policy probably about 10 years ago, I believe. 9 years ago. And again, I'm talking to him, and he was hell bent on doing term. I said, okay, because I'm going to give you what you asked for. I'm going to educate you first. And then after that, whatever you choose to do, it's on you. Now, when I did his policy, he had the best rating that we had, Preferred Plus. He's my height. He was probably my size at the time. So like 215, 220, somewhere around there. Fast forward 9 years later, the gentleman was eating good because he's now almost 300 pounds. And the insurance company, the rate that they gave him was 4 levels down from what he had before, which made the premium go up excessively from what he was paying before. This is some of the reasons why I say the buy term and invest the difference idea doesn't work. It's a theory. It's fantasy. Because life changes. Life happens. Right? Or health change can destroy. If you put this in place, this buy term and invest the difference, all it takes is one health situation to wreck this strategy. That's how unbalanced this strategy is. Buy term and invest the difference assumes you still qualify later. And nobody can assume that. Buy term and invest the difference assumes you'll still be healthy later. We live in the United States of America. Diabetes is high. Stroke is high. I think America has the most cases of heart attack of all the nations. Buy term and invest the difference assumes that your new premium will still be affordable later. And it may not. Life may have changed for you. Your income may also be different. You may have lost your job. Anything can happen. Over time, people develop high blood pressure. diabetes. Let me give you an example. It was a gentleman who I did his policy about 3 years ago. The wife lost the job, and he couldn't maintain the policy payment because the mortgage was like $4,000 a month mortgage, and they had cars and everything like that. So the wife got sick, and the wife couldn't, work anymore. Also, the wife, when I did his policy, she never did a policy. That's a conversation that me and him was having. Like, man, if your wife would have done that policy, you could have taken money for the policy to help you guys sustain right now. But we can't even get her covered. But he let his policy go because, again, the wife stopped working because she couldn't work because she was sick. Now he's paying a $4,000 mortgage on his own, electricity bill, just maintain the whole household, and everything was tight. So he let the insurance go. Fast forward 2 or 3 years later, things are settling just a little bit. He wants to get a policy. Now, the man has high blood pressure, which he didn't have before when we did his policy. Right? This is how instant anything can happen. So this is why I personally believe the permanent policy make more sense. Okay? As you put on weight, some people get sleep apnea. And sometimes insurance company don't like clients with sleep apnea because some of them can suffocate in their sleep. Cancer. One of my good friends who I've known for 30 plus years. She's a client, the most healthiest of a person. I'm talking about 5'8", no more than 140. Healthy. Don't eat meat, don't eat pork. Got diagnosed with cancer. It's a good thing she had a policy because in that scenario, was able to file a claim for critical illness on her policy, and they cut her a check for $78,000. So, but this is how quickly a person who was healthy for the past as long as I've known her, and then we did her policy 10 years ago, and then all of a sudden she went to the doctor and they found something. Heart attack. Right? So your health changed over time. And then all of a sudden, that will convert later becomes you can't convert anymore. That's the number 4. That's the number 4 reason why the buy term and invest the difference doesn't work. Listen, again, as you are on this live, please get your friends and family on this live because a lot of people need to know this information. We got 48% of the country without any life insurance. We got another 68% of the 52% that have life insurance saying that they know they don't have enough or they are underinsured. You want to financially cripple your family? Walk around without life insurance and let some health situation happen. Some of you guys should ask around and ask people how much it costs you or how much it will cost when you're caring for a person with cancer. How much it costs if your spouse gets a heart attack or stroke and you were dependent on their income monthly to survive. some of you guys should call around and or talk to people who have experienced this situation. And see how financially crippling it can be. You know, the number one reason why people lose a home? The number one reason why people lose their homes is not because they can't financially pay for it in most cases. It's usually somebody falls sick. And it's usually either the breadwinner, or if not the breadwinner, the spouse, because now the breadwinner got to take time off of work, which is now lost income and lost wages, to take care of this person. Or the breadwinner got sick and now their income is gone. The number two reason why people lose a home is somebody dies. I had a family in Vienna, Virginia. This was before COVID, about 4 or 5 years ago. And this guy, some kind of electrical engineering, making a crap load of money. And the wife is a nurse. And they had this magnificent house out there in Vienna. And I went there to talk to him about doing life insurance because it was a referral. The guy said, "Oh, we'll get back to you later." And they never did. The gentleman ended up having a heart attack while driving. Six months later, they are moving from that house because the wife, as a nurse, I believe, was only clocking, and I said only loosely, like 102. The husband was making like $250 or something like that a year. And that house was at least about maybe $4,000 a month in mortgage payment. The kids were in private school. Okay. They had a couple of Mercedes out in the driveway. The size of the house, I can only imagine the utility bills and the maintenance of the yard and all that stuff. There's no way she could have maintained that. The fifth reason many families are underinsured from the start. Buy term and invest the difference doesn't work because many families already are underinsured from the start. And in most cases, because it's a term policy, these people end up buying the cheapest term policy possible anyway, because they're selling people on cheap policy. They're telling you don't buy whole life or IUL because the cost is more. So buy cheap term policy. But what they're not explaining to you is the benefit of having a whole life or an index universal life compared to a term. So again, as you're watching this live, if you're one of the people that have policies from these particular companies, DM me. Let's review what you currently have. And then let's lay down and talk about the option that you have available to you. Okay? And then we can go from there. Even in most cases, with that particular company, I found that whatever their client is paying, I'm usually able to get them double the coverage because their policy are just expensive, which I'm confused because they tell you don't buy whole life or IUL because the price is too high. But then they sell you expensive term. But you only think it's cheap because comparable to the IUL or whole life, it's less. But in reality, if you compare it to other companies' term, it's way cheaper to other companies than what they're offering you. So if you have to have a term policy because of your financial circumstances right now, why would you want to pay the most expensive term? I mean, it's a term. It does one thing. You die, they pay. That's all term do, all across the board. So why would you want to pay the most expensive or pay for the most expensive term? Right? LIMRA reports that 42% of the US adults say they need life insurance or need more of it. This is a record high number. 42%. A lot of people are walking around here leaving their family or going to leave their family in a financial bind. Reason number 6 why buy term and invest the difference do not work. The sequence of returns risk can destroy the invested difference. The sequence of returns, which is interest, can destroy the invested difference. Even if they invest consistently, retirement and income timing matters. If the market drops hard when you need to draw from the investment account, let's say a job loss, disability, early retirement, the plan can fail because withdrawals lock in losses. Term insurance doesn't protect you from risk of needing money while the market is down. It only pays if you die. That's it. This is one of the reasons why and I'm not trying to be biased with this, but I'm a fan of the IUL, the Index Universal Life, because of the flexibility that it gives you. Okay? Also the safety and the protection that it gives you from the market. If the market take a loss, I don't take a loss. But if the market earn and grow, I grow along with it. It's like the best of both worlds. I don't understand how, well, I know these agents don't tell these clients this because they don't offer these products. Because to me, I don't know how a person can sit down and you present to them, hey, you buy this insurance here, and after a time frame, you're not going to have it anymore. Or B, you buy this insurance here, and this insurance will last you forever. Oh, also, by the way, 20 years from now, 30 years from now, you can start to now get income stream from this particular plan. Oh, by the way, unlike your 401k, the money you put in here is protected from a market loss, which means if the market goes down, I don't lose any money. Oh, by the way, when I withdraw money from this particular plan here, I don't pay taxes, unlike my 401k. I don't know how anybody would say, oh, give me the term. I don't know how anybody will logically say, I'll take the term, unless it wasn't explained to them properly or explained to them at all. If you're on the live right now, can you put in the chat, if you have a term policy, put term. Type term in the chat if you have a term policy. And this could mean if you only even have it at your job, because a lot of people just have insurance at their job, which, by the way, is defeating. Because let me explain that part to you. And here's the deal. I don't want anybody on here thinking I'm talking bad about the term or I'm against the term. I'm not. I'm just here to educate you so you know what you have. So you're not surprised when you receive that letter, excuse me guys, from the insurance company saying, hey, your term is about to run out. So call your agent so you know what your new renewals payment is going to be. Okay? So again, like I said, this is all about education today. So I don't want you to think I'm against the term. I'm just here to educate you so you know what you're getting into. Right? Job insurance. Let me explain to you how this is going to play out for you. And it's not going to be on your side. You're only covered while you're at the job. Also, if you're a teacher, if you're watching this, you're only covered during the school year. So when you're on vacation, during that school year that the kids are on vacation, you're actually without coverage. So if anything happens to you during the summer, and that's the only plan that you have with the job insurance, your family might be in trouble. Okay? Outside of teachers, if your only insurance that you have at the job is what you have, when you leave the job, a couple of things can happen. One, for sure, you're going to come out of a group plan into an individual plan based on your age at that time and how much coverage you want to keep. Then they'll give you the new premium. And at that moment is when most people say, I'm not going to pay that. And that's when they call me. I'm dealing with a lot of retirees right now, especially government workers who have been in the government for 30, 40 years. And in their mind, they thought their policy goes with them. And they have to find out, no, that's not how that works. You're only covered while you are at the job. Once you leave the job, you can keep it if you want to, but just understand you come out of a group plan, which is the reason why it's so cheap, to an individual plan. And then they'll calculate what your premium is going to be based on your age and the amount of coverage that you want. Option number 2. Okay, they let you keep it. Your premium is pretty much going to be the same, but they slash your coverage like almost as low to $25,000. And again, that's when they call me, because at 65, they probably still have a mortgage. They want to make sure if something happens to them, their spouse are going to be able to keep the house. And $25,000 ain't going to cut it. So when I tell people, don't bank on the job insurance, and some of you who are watching this, you need to call Human Resource first thing tomorrow, and they'll let you know. Okay? It's a group term life insurance to cover you while you are there. So if you get fired, you don't have it anymore. If you lose your job, if you leave, if you leave, you don't have it anymore. If you retire, you don't have it anymore. Or you get to keep it based on those two scenarios that I just mentioned. I hope you guys are taking notes today, because I can't tell you how many people I meet every day and they act surprised and shocked about this. Like, oh, I thought I could take it with me. I've been paying all this time for 40 years and I thought I can take it with me. How did you think that? Right? How? And on top of that, most people now been in the job for 20, 30 years, 40 years. Now, when they could have had insurance outside of work all this time and locked in a real low rate, now they're 40 years older. Again, they may have had some health issues that may have happened to them. I've written enough policies this year. I just did one for a client in DC. She has some insurance at the job. We only did about $150K for her as a policy. At the time when I did her policy initially years ago, over a decade ago, she didn't own a home. But now she owns a home. And she's retired now, and her insurance doesn't go with her. But this individual who was mad healthy, she got preferred elite rating. You know what that is? That means she's superhuman. That's what this woman got. When they did her lab work and everything, this woman was the cleanest, preferred elite. Okay? To go 10, 12 years later to having heart issue, diabetes, high blood pressure, and her mortgage balance is almost $400,000. She's in her 60s. She just bought the house 5 years ago, which means she's going to have a mortgage payment until she's probably 90. So we could only get her a lesser plan because the price that they was trying to give her for the amount of coverage she wanted was just way too high, because she's in retirement now. So now she has a monthly income budget. So when I tell you guys that tell me, oh, I got insurance at my job, okay. Okay. Because what you're doing now is you're gambling with time. You're now gambling with time. And time will win every single time. Again, and let me say this, and I hope I'm not offending anybody today. I hope I'm not harsh with it today. What I want us to do going into 2026 is be financially sound. Everything I'm going to be doing for the next week or two is to educate you, free at that, as to financial moves you should be making going into 2026. And it's up to you if you do it or not. Right? But all I'm be doing is educating you so you have knowledge. So when you buy insurances, you know how it works. You're versed at it. You understand the difference between the term. You understand the difference between a whole life, the difference between an IUL, and you can make sound financial decisions that will benefit you and your family, and not some agent coming into your house and telling you term is the best. You can now ask them questions. Like, for example, if I buy a term policy and I buy a 30-year term policy, what happens to my policy 30 years later? I guarantee you will shock them because they don't think you know that. Okay? And let them answer you and see if you like that answer. And if you're watching this, let me give you my number again. Okay? So that we can save it. So if you run across these people, if you choose not to call me, right? After you run across them and they answer you, then you will be calling me. That number is 443 208 5480. That's 443 208 5480. Texting works best for me. If I don't know your number and you're calling me, I'm probably not going to answer for a while unless I check my voicemail or whatever, and that could be days. But if you text me and you let me know who you are and what you're looking to do, I'll call you back right away. So if you have job insurance only, please, please, please do not leave your family exposed. I want to say something else, but I'm going to try to keep it clean. Do not leave your family exposed. You should have insurance outside of work that you control. That you control. Because you don't control that job insurance. They do. Once you leave, it's done. You don't have it. Right? So, give me a second, guys. Alrighty. If you're watching this live right now and you have a job insurance, I want you to comment job, and don't be ashamed about it. We are here to learn today. We are here to educate today. Right? Reason number 7 why buy term and invest the difference do not work. Life happens. Layoffs, divorce, business failure, caregiving. I've been around for 18 years, so I'm going to be sharing a lot of stories. I got stories for days. 10 years ago, I did a policy for a client of mine in Bowie, Maryland. And these husband and wife, like big time people, making great money. And they must have forgotten the policy I did for them. But they was doing roughly $700-800 a piece. And it was just pain, 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 pain. The wife got diagnosed with brain cancer. And one day he calls me, just having a conversation, talking about the struggle of caring for her and all these things like that. And I'm like, why are you just calling me now? He's like, what do you mean? I was like, a lot of things. Your policy has living benefits. You could pull money from that policy that can allow you to pay for a nurse aide to come in and help you. He was like, what? He said, what? I was like, yes. On top of that, when I logged in and looked at their statement, they both had over 150-60K in cash value. I'm like, if you don't want to touch the insurance side, you got money in the cash value side that you can pay a nurse at least $3,000 a month to come in and help you while you go to work. Or even when you come home, she can be there at night to take care of your wife so you can get some sleep. He didn't know this. And he was so happy when he found this out. And we found, I mean, listen, have you ever talked to someone on the phone and when you're talking to them, you can feel the stress and the anxiety through the phone, but then you give them good news and you can feel the weight just lift off of them? That's what that conversation was like. I can feel the weight just lift off of him. His voice changed. So when I tell people buy term and invest the difference, I got story for days as to the reason why that worked, why that doesn't work, and why investing in a whole life or a IUL make more sense, because life happens. Reason number 8, and I'm gonna try to close this out with you guys real quick, as to why buy term and invest the difference doesn't work, is again, employer coverage creates this false confidence. You know, a lot of people walk around and say, oh, I work for the government, I'm good. No, you're not. I know that for a fact because I got a lot of government worker clients. And I know what the government offer. And no, you're not. Oh, I got a good job. I don't know what that is, but no, you're not. You're only covered while you're there. And if they let you take it, again, two things are going to happen. Out of a group plan to an individual, yourself, and the insurance company now, at your age, and how much you're buying for coverage will give you your new premium. And most people, 90% of the time, cancels unless they have a health condition going on, like cancer or something like that, and they want to keep a coverage and they're willing to pay that high premium. But in most cases, people cancel. And that's when I get phone calls. Oh, my mom, can you give her a call? She needs insurance. And I'm like, okay, cool. She just left her job and she found out she can't take her insurance with her. Okay, no problem. So I want you guys to keep that in mind. Reason number 9 as to why buy term and invest the difference do not work. Their policy does not have living benefits. Most families don't just fear death, they fear long-term illness, long-term care cost. Listen, if you have a family member who's sick, in the state of Maryland, and you guys can look up your state, in the state of Maryland, to put them in the assisted living facility, at least a decent one, not a good one, a decent one, it's about $105,000 a year. If you now say, well, I don't have $105,000 a year. Okay, cool. If you want the nurse to come in and take care of your loved one, now we're talking about $4,800 a month. So their plan doesn't have living benefits. You guys should do some homework and see how much long-term care costs. If you don't want to be a burden to your family, you may want to consider getting life insurance with living benefits. Most people, they have basic life insurance. I don't think I've ran into a client that has a policy that's had it for years that the policy have living benefits. And that is important because nowadays people are getting cancer out of nowhere. Diabetes, renal failure, heart attack, stroke, and young people at that, not someone who's 70, 80 or whatever. No, people like in their 40s and 50s. If you want to evaporate your life savings overnight, let something tragic happen health-wise and see how fast your life saving goes away. If you don't have long-term care coverage or some form of long-term care coverage, see how fast. And if somebody on here is going to say, oh, Medicare does not cover long-term care. If you want to cripple your finances, see how fast that happens if your loved one gets sick. Instantly overnight. So their plan does not offer living benefits. Number 10. The 10th reason why buy term and invest the difference do not work is the math comparison are often unrealistic or cherry-picked. A lot of buy term and invest the difference math, which is the age and doing the math, assumes constant high market return. No taxes and fees friction. Okay? Perfect investing discipline. No interruption in the market and investing for 30, 40 years. That's the assumption. No timing risk. And they're assuming you won't need life insurance coverage after the time frame you purchase is over. And we know that's a lie. Who is that guy? Is it Maury Povich or Jerry Springer that does the DNA thing? Like, this is a lie. This is exactly what it is. Listen, I hope I helped somebody today. I hope I helped somebody today. Because, again, I'm not against term, but what I do want you to understand is what you have. So when it's about to be over, I don't want you to say, oh, I didn't know. I'm going to close out with 3 scenarios that's going to allow you to think about this overnight. All right? Okay? The first scenario is a gentleman who outlived the term and then died later. Chocolate Bunny. Yes, educated. Thank you. Thank you. I hope that helps a lot of people today. Because a lot of these agents don't do a lot of education. They just sell. The first scenario I want to talk about was an individual who bought a 20-year term at 35. And this individual didn't invest the difference consistently. The term ended at 55, and the gentleman died at 58. Result, no death benefit, no investments on pile, and spouse was forced to sell the house. I got stories for days. This is what almost 2 decades of being in the industry do to you. And especially when you are an agent who's really out there in the field. I see over 300 people a year. I have over 3,000 clients on the books right now as we speak. Scenario number 2. The client initially planned to renew, but got sick. The term ended at 50. She was diagnosed shortly after. The new coverage became expensive and she couldn't maintain the payment. And she had to let it go. Scenario number 3. They bought the term, and I'm pulling this from people who I've sat down with that fell for this trap, is what I call it. They bought the term policy, which I end up getting them double the coverage for what they was paying, right? And I also end up doing an IUL for them on the side, so when the term run out, then the IUL will still be there, because this gentleman needed $2 million of coverage. They invested, but pulled it during a downturn. So they took money out. So they invested the difference for years. The market fell. The gentleman also lost one of his position. Okay. And withdrawals locked in losses. The investment never recovered. The term expired later. Now the family is underprotected. That was a scenario. That was a scenario. I'm going to close out with my option. And I thank you guys for hanging in there with me tonight. Okay? Because I want to do some serious educating. Again, We're going to go into 2026 financially savvy. Okay? We're going to listen, you're watching this live right now. I want you to put in the live if your intention is to prosper in 2026, I want you to type prosperity. If your intention is to prosper in 2026, I want you to type in prosperity and we can get there together. Right? My suggestion to you, if you have a term policy, is to consider a whole life, a GUL, guaranteed universal life, or a indexed universal life policy. I prefer the indexed universal life policy because your potential for growth is so much higher with the indexed universal life policy. And the policy is permanent, which means it will outlive you. As a matter of fact, not only permanent, with most cash value policy or permanent policy, let's say you invest in it for about 25, 30 years, you no longer have to make premium payments. Because due to the power of compounding interest, the huge lump sum that you have in there is compounding and compounding, even while you're taking out income stream. So I put money away in this policy for a certain amount of time. So I'm 30 years old. I invest in this thing for 30 years, for example. Now I'm 60 in retirement. I start to pull from Social Security. I might start to pull from, let's say I have a 401k or an annuity or whatever. And then I also tap into my life insurance. And this all depends on if you want a extravagant retirement, retirement. You may not want to touch the money in your IUL. You may not want to touch your annuity and just pull money from the Social Security and the IUL. But it gives you that flexibility compared to having a term and so-called investing the difference, which most people never do. And then the investment that you're investing in are risky investments. So the IUL make more sense. Listen, I'm going to wrap this up. And again, if you guys want to talk more in depth, one-on-one, you can DM me or you can text me at 443-208-5480. That's 443-208-5480. Listen, outside of that, I appreciate you guys getting on the live today. You guys have a wonderful and blessed evening. Love you guys and talk to y'all soon.